Welcome to this stock analysis report for Star Energy. Please remember that this is for entertainment purposes only. I first invested in Star Energy back in 2022. It's actually my worst performing investment ever. It's down 90% from then. And I gave my portfolio a bit of a purge on Friday, and this stock was included in that. However, it was kind of an inconsequential holding anyway, really. It was only 0.1% of my total portfolio. Star Energy, of course, used to be called iGas, and I've done loads of videos on it, so take a look at those if you've not seen them. My last one was a year ago when they reinvented themselves as Star Energy, and they've been putting money into investing into geothermal. A running theme throughout all those videos was the question of, even though Star Energy are valued with an NPV10 of 188 million, why is their market cap only about 9 million? They appeared to me to be extremely undervalued. Well, they just came out yesterday with their latest resource report, and here we actually had a updated valuation of 188 million in terms of the NPV10 of their resources. This is actually a drop from last year's report. And given that that report came out at the end of 2024, when the oil price was around here, that downgrade can't be because of oil price. So I guess it can only be maybe they've taken into account some of the projects they have, which they may have decided not to develop. All the same, this revised number of 188 million is much higher than their actual market cap of 9 million. So I thought, before waving goodbye to Star Energy, I'll take another look at their valuation. In their competent persons reports, they have a nice outline of all of their assets, and they also provide resource estimates for each oil field. And so I've been plotting them, and then that allows me to create a guesstimate of what the production is at each oil field. It's really interesting because three of them, Welton, Singleton, and Glentworth, make up the vast majority of actually all of their resources. A lot of them fairly kind of making tiny contributions. In terms of production, Singleton, according to my rough calculations, seems to be about half of their production with just that one field, with Welton accounting for about 20%. And they've highlighted that Stockbridge is important as well. You'll see that in some cases, the resources actually increase from year to year. And this is where they can do engineering work at particular sites to increase access to more of the oil that's down there. But it has been impressive over the last 5 years how they've been able to increase the reserves through great engineering work. This is quite a credit to this company that they know what they're doing. When I look at the Glentworth oil field, this both offers an opportunity but also presents a challenge for this company and for myself as a potential investor. They actually achieved planning permission from the council to do phase one of a two-phase project, which would actually add a considerable amount of oil to that oil field. And in fact, the NPV value of just phase one comes out at 17.5 million. So that means that just that phase one work at just that one oil field would create value to the company far exceeding their current market cap. And obviously that fact on its own presents themselves as a kind of compelling buy, let alone the situation of the overall NPV value. This project's still on hold because the Environment Agency haven't processed the application they've made to give the environmental approval, even though they applied for that back in 2022. So Glentworth, we have one project that's had planning permission, which if it happened would be a very compelling time to invest actually. But then the bureaucrats at the Environment Agency, it appears, don't want to approve this project. And that presents a big problem with this company. The general sentiment amongst the government bureaucracy is to do everything it can to destroy the oil industry. And so this is a real challenge for this company that you've got to take into account. So I'm determined to get to the bottom of this valuation thing. So what I've done is I'm going to make an attempt to value them, but I'm going to be as harsh as possible so that the answer I get gives me the highest confidence answer possible as to whether they're overvalued or not. So to start with, I'm going to look at their short-term assets and liabilities. And their short-term assets is all good stuff. Their inventories, trade receivables, and cash, and that totals about 12 million. So in terms of short-term liabilities, it's about 8 million trade payables, 4 million this various stuff, this various bitty stuff down here, and about 5 million short-term debt. So there's a bit of an issue there because they're actually negative 6 million when you take away their current assets from their current liabilities. And generally, it's not a very good sign of how a company's doing to me when there's a shortfall like this, comparing their short-term assets to their short-term liabilities. A lot of the problem is this short-term debt down here. Anyway, that means that on their liabilities side here, I've given them 6 million of net short-term liabilities. In terms of their long-term liabilities, it's good that they've got no long-term debt. There's about 9 million of kind of miscellaneous here and 61 million of provision. Now, provisions are the money they're going to have to spend to restore all of the oil wells back to nature when they've finished extracting all the oil from each site. So for the long term, it's, as you can see, most of their liabilities are their long-term provisions, and then I put in the other stuff there. So overall, this gives them liabilities of 76 million. Now looking at their long-term assets and the intangible assets and right of use assets, those are fairly abstract kinds of assets. So, and it's totaling 16 million. So I've put that up here at 16 million. Then we see the majority is their property, plant and equipment at 72 million. And then the rest, but a substantial amount, is their deferred tax assets, which are tax credits that they've accrued. Now, like I said, I'm going to be as harsh as possible to them here because I want to make sure that if I arrive at a undervalued situation, I can be confident in that. So I'm going to be really nasty to them here and not include these intangible and right of use assets as assets. And also the property, plant and equipment I'm not going to include because although I'm sure the accountants are going to hate me for this, that property, plant and equipment will get amortized down to nothing over the life of all the wells, and that comes out here in the expense line. And essentially, let's be really nasty and just assume they're not going to be able to sell their business to anyone ever. And so all of the property, plant and equipment is kind of going to be worthless at the end of the day once it's been used to extract all of the oil resources and stuff. Actually, maybe that amortization gets included in the NPV10 value. And then the deferred tax assets, you need to understand the world in 5 dimensions to get to the bottom of that. I actually discussed it in great detail in my last video, so go and have a look there for the detail. So I have decided to include this as real assets for my calculations here. So then when I deduct the liabilities here from the deferred tax assets, because remember I'm not going to give them this and I'm not going to give them the PPE, that results in a harsh valuation of negative 35 million. Okay, now in terms of the NPV10, they have a base case and a low case. So because I'm being really nasty to them, I'm going to take the low case. And that low case, by the way, is assuming $67 oil, which by chance is roughly where the oil price is now. And then, of course, we've got to convert that into pound sterling. So it's only 109 pounds sterling. So when I deduct my harsh valuation from the NPV10, even then, even not including this other stuff here, I still get a valuation of 74 million. So that would suggest that if you're going to use the MPV10, they're 10x undervalued here. Okay, so whilst editing the video, I checked on a few things. I need to correct my assumptions here on the valuation. So in terms of the competent persons report, and these are the calculations they use here, and these numbers to get the 2p NPV10 number, I checked with Grok, and actually the capex is included, or the amortization of that capex is included in the calculation. So that means I should include the PPE here, because it wouldn't be fair to include it, to not include it here, but then only deduct it on the other side. So I'm including the PPE number, and the provisions are included in this calculation. So I'm going to take away the provisions here, because it wouldn't be fair to count them twice, or actually to deduct them twice. So that gives me this new harsh valuation of 130 million, which then, when added to the NPV10, actually gives us 239 million. And another thing is that I noticed in the small print here, whilst I was just even doing the editing, this reports do not include tax. So that means we have to apply tax. So according to Grok, they're paying 50% tax roughly. So that would give us a value at the end of 117 million. Now that's complicated actually, because the actual tax credit help drive it down. But even let's say it was 80% taxes they were paying, which is the worst case here. Even then, if it was 80% tax, and it's probably on average, on aggregate, probably something like 60 to 70 once the tax credits are used out. But let's say absolute worst case, 80% tax, that would still be something like 50 million. So even then, there'd still be undervalued. But I want to just also check if that's true. Are they still actually turning a profit? Because there's all kinds of complicated stuff going on here. So I just want to kind of verify that, a bit like a second source of evidence, if you like. So looking at their revenue, and oh, by the way, in 2023, this was a kind of good year for them. You know, this was with the oil price between 70 and 90, let's say. So this makes a good reference point actually. And they achieved revenue of 49 million. And then their depreciation, amortization, plus the other cost of sales, plus admin, plus R&D, plus these other bitty things, it all came to about 42 million. So they had an operating profit of about 7 million. And actually, of that, 8 million of it, this depreciation, amortization, that doesn't actually require them, that doesn't actually really require cash flow. They don't actually have to channel any of their revenue to pay off any of that. So just from the operating profit, it's kind of looking okay. But then we have this financial costs of about 5 million. And then we have tax. So they claim tax credits, and they would have paid like a little bit of tax as well as part of that, which weren't the tax credits. And then that's how we get to this negative 5 million number. Now, I don't know how much tax they'd have had to have paid if they weren't paying the tax credits. But my kind of rough guess about that, again, if anyone knows, please put this in the comments. But my kind of rough guess is probably, maybe it would have been something like 1 million, and they would have had a net income of about 2 million. So I've kind of got a bit of uncertainty here, but it does kind of appear that they would have made a couple of million if you don't take into account the tax credit thing with the debt. But without that debt problem, they would actually be turning quite a nice profit, probably actually looking at least kind of half of their actual freaking market cap. So there's still unclarity about their profit and loss state profit and loss statement here because it's got some very complex things going on. But it kind of looks like without the debt payments and without spending money on the geothermal stuff, they could actually have a fairly decent net income, possibly accounting for like half of their market cap. The problem is though, is that they are chugging a few million at the geothermal stuff, and to my disappointment, in their 2024 half year, they still had 5 million of short-term debt, even though previously they said that it would have been all paid off by then. And actually, in order to fund some of their geothermal stuff, they actually raised, having paid off their long-term debt at long last, after so many years of being in debt hell, having finally paid off their long-term debt, they announced a 25 million credit facility in order to fund a load of their new geothermal stuff. So in terms of checking their profit and loss to see if that corresponds what the apparent undervaluation suggests, it's still a little bit muddy and complex to really thoroughly understand. But it looks to me that with the geothermal stuff and with them still having debt, it's problematic. It's not like a clean hit here that I'd kind of want if I was to go back and invest in them. And I certainly want to see a couple of more annual reports. I understand that they've actually have sold 6 million worth of land actually, which will be coming in the 2025 statement. It'd be good to see them kind of debt free, or see that the kind of geothermal financing stuff isn't really interfering with their oil stuff. I feel like I need to see particularly the 2024 full year data and 25 data to establish that this apparent severe undervaluation of the company can actually translate into them turning some good money for a sustained number of years. It kind of looks to me overall like the value that they're unlocking from this is being funneled into the geothermal direction the company wants to go in, when it could have been used to instead make the balance sheet exceptionally strong. But then I do understand that the management have a bit of a dilemma in that really they've got a choice between two things. One would be to just pay out dividends and stuff until all the oil fields dry up, and the other is to invest it into new things like the geothermal to try and find future growth. So I know that the operating costs are $41 per barrel at the last update. That means that the closer we go to $40, the more that this MPV10 will shrink to nothing actually. Presumably at $40, that will shrink to nothing. And so this does make the oil price important. And for me, I'd want to see I'd want to see the oil price back up at $70 before I went in again. So to summarize, on paper, in terms of the assets, when you consider the value of the resources of all the oil fields they own, they do appear on paper to be 10x undervalued. But there might be something I'm missing. And when I try to cross check that with their income statement, it's far too complicated with the tax credits as well to really understand that. It appears that the value they're getting out isn't what I'd want to be. isn't what I'd want it to be if this was the reason I was investing. And I think that a lot of that is because a lot of their value is going into the geothermal stuff. And I really would like to have a look at the next bit of numbers to see that they really are making some good money from these assets. And finally, the oil price. I think if you were going to go in and take a bet, I'd want to see it above the $70. So that completes my video for Star Energy. They're a great way to invest in geothermal as a very risky speculation. But for me, there's some things there that I'd want to see before I went back in. I hope you found this video useful and speak to you at the next one. I do videos like this one just for fun as a hobby. It's for entertainment purposes only. Always consult a qualified financial advisor before making any investment decision.